Roberto Perli is joining. He's the head of global policy research at Cornerstone Macro. Roberto, great to have you here. Always a pleasure to have your team on the show. You guys do great work. And the question, of course, is right now, what do we go to for the comparison? Does the '08 stuff make sense to you?
Yeah, good morning. Thank you for having me. Look, I think on the surface, the economics, if you want, of the situation so far are not as severe as the 2008 crisis was. But yeah, as you said, certain moves in the market are certainly indicative that the market is really worried and the level of concern in the market is back to what it used to be. So I think policymakers like Powell, Lagarde, and others are very right to take this episode seriously.
So right now, how do we distinguish the expectations that have not yet occurred from what is the evidence already within the economy? Because it seems a lot of this is about getting ahead of an expected decline in the economy. Jay Powell's cut is not coming necessarily in reaction to any data here or any of his original mandate. It's coming from what he sees around the world and assuming it's going to hit us in the same way. How do you track within bonds what that means? Well,
you can always look at the 10-year rate, like the quintessential barometer for this, what the market thinks about the economy. And the 10-year rate contains information about several things, contains information about inflation for sure, contains information about sentiment, hedging, fears, which is called the term premium. But it also contains information about growth, about what the market expects average growth to be over the next 10 years. And until about 10 days ago, the market was fairly relaxed about U.S. growth. So growth expectations declined just a little bit, but in the past 10 days or so, they started dropping very fast. And normally, in the past, when that happened, that has never been a good sign in terms of what economic development we will see later.
So we've got your decomposition of the 10-year. Love this idea between growth, inflation, and then, of course, the more ambiguous kind of term premium. But should we have another bar here now, Roberto, which is playing the Fed? I mean, this is the question, right, is how much can we believe the bond market when they rallied ahead, inverted the curve, Jay Powell cut without any reason in his mandate by 50 basis points, and then bonds rallied on top of that? It's like this circular thing where I'm going to buy because I know someone else is going to buy, and then when they buy, I'm going to get paid.
Well, I think you have a point there because, look, I would say the market is leading the Fed at this point, right? So there was a time in late February where the Fed was pushing back, right? So there is not a situation where we would cut, not immediately, we want to see information. And the market couldn't care less. The market kept bringing rates down, expectations down, and the Fed had to follow. They had no other choice. So the market is leading the Fed. And look, there is a reason why interest rates are so low at this time. And the reason is the market is really worried about the future, not just the immediate future, but the longer term future. Look, if you look at, for example, the OIS curve, so what the market expects the short-term rate, federal funds rate, to be over the next 10 years, it plunges all the way close to zero. And 10 years from now, the market thinks we're still going to be at 50 basis points. So I think the market has in mind something close to a Japanesification of the U.S. economy, if you want. I think that's concerning.
Yeah. You've got another chart. We've been doing a lot of distribution and return distributions on this show lately. We looked at the one for stocks earlier that showed the 19-day move was almost a 6 sigma event. How about this move in the growth expectations for the 10-year? Were you able to quantify? I see a chart here that looks like something similar, that it's way, way out on the tail.
Yeah, absolutely. So that was a 1 day or 2 days move initially early last week. That was, I don't want to say off the chart big, but it was very big. It was within, I think, the top 0.5% of all historical moves. So yeah, it's definitely big. Another thing that is huge and actually unprecedented since recorded history started is the drop in the expected federal funds rate 2 months ahead. It never dropped since 1991 when federal funds futures started trading. It never dropped this fast. And again, that's another sign that, number one, the market is leading the Fed, and number two, the market is really worried about the situation.
Now, you also in your report state that the big expected Fed cuts, though, and this is from a week ago, is not necessarily a sign of recession. Walk me through that. In the past, so I go down the list of when the Fed had these big cuts, double cuts. We're not in good company, is basically the message. All those other periods were pretty intense.
Yes, all those other periods were obviously intense, right? So the Fed usually, so they have FOMC meetings for a reason. So those are the meetings where we can change policy. If they change policy in between meetings, that means that they have a serious reason to do that. And that reason, obviously, in this case, is the coronavirus, the potential consequence of the coronavirus. But in the past, it was the great financial crisis, the burst of the equity bubble. And what is interesting is that in the past, when the Fed cut intra-meetings, almost always it cut 50 basis points. And always, the very next meeting, they cut again by almost always the same amount. In other words, Fed is worried, cut intra-meeting, and then cut again because the situation is getting worse rapidly. So I think this has to be the expectation again for the meeting next week.
What right now, from your team and the various expertise you guys have across different areas like policy, economics, the overall supply chain? We were just looking at the chart of the way those growth expectations were compressed so quickly. How does that then get affected going forward? I mean, what are the big shoes to drop here? What's most important to assessing whether or not this does lead to recession? Is it the U.S. consumer just grinding to a halt? But I mean, we're a very services economy in terms of what we can do online, what we can buy even without going out. Is it a question of whether or not there's reinfection in China and the supply chain shock comes back there? Like, what's the big if here, Roberto?
Well, I think what you listed is a very good and comprehensive list of concerns that we should have, right? So supply chain is definitely important on the business side. The services is important on the business side and the household side. So I think we'll have to watch how much disruption there will be here going forward. Now, the good news is that the U.S. economy entered this episode on a very solid footing.
Yeah,
it's not spectacular growth, but the U.S. economy was holding up well. Data were improving, so that's encouraging. But other countries, as you've seen, China, but also Italy now, are virtually shutting down the whole country. Right? So if that happens here, I think there is reason to be concerned that growth will diminish substantially in the next couple of quarters.
Should we be considering the very non-consensus view right now at all, Roberto? In your guys' research, do we need to assess the data and the status of the economy coming into this event? Today we got CPI, was very solid. It's the second reading in a row that was a tiny bit warm. PPI was pretty warm the last time around. Our employment number last time just crushed it. I mean, a lot of these are pre-coronavirus here in the U.S., but some of these numbers are not pre-corona scare worldwide, and they hadn't fallen off yet. So if the Fed got ahead, just juiced up the economy even more, do we need to think about the other counter risk that then there's a big inflation scare on the other side, or is that just bonkers to even think about?
Well, it's not bonkers, but I think this is initially a supply shock. Supply shocks are inflationary, and so I think it makes sense to think about the inflation side. What it also makes sense, though, is to think about the fact that this supply shock could very well turn into a demand shock, and that would be disinflationary, right? Which is what the Fed is worried about. The whole reason why they cut rates, and other central banks are doing the same thing. Like, so that's the concern that central banks are trying to mitigate, right? So it's not happening now, but it could very well happen later. So put in place easy monetary policy today to help tomorrow. There's nothing the monetary policy can do against a supply shock, but it is something they can do against a demand shock. Now, the other thing to say is, unfortunately, we don't have a lot of monetary policy room here, right? Because rates were already low. Certainly, they are much lower today. Fed can lower them even further, but I think the power of those instruments is not what it used to be. So I think that's why you heard Lagarde yesterday, but you heard any central banker saying we need help of fiscal policy to try to get us out of the situation if it deteriorates.
And that's what we're waiting for today. Do we get anything? Do we get the update? Roberto Perli, great work. Great to have you here. Really a nice insight ahead of global policy research at Cornerstone Macro. Thank you, sir.